Thanks, Josh. And I'm not sure what's going on with my video setting, but hopefully you can hear me just fine. Um,
Yep.
Personally, I don't have any interesting horse stories to open up and share with you guys on like Jason did, but hopefully some of the discussion that we have around PPP will be insightful or helpful for you guys as you're going through this process. So, as Josh just mentioned, I'm going to spend a little bit of time discussing some of the control implications around PPP loans, and then we're also going to Marshall and I are going to spend a little bit of time talking about some compliance-related issues, as well as some risk management considerations to take into consideration. So, with that said, I think while we know that the PPP has been a very dynamic, fast-moving process over the last few months, and came at a time where most certainly we're trying to do our best to support the economy, support small businesses, given the quick shift in sort of work environment, moving from an office location to remote settings, some of the technological issues that went hand in hand with that. We know that it came, both of these areas came at a time where it made for a challenge in the establishment and controls, and specifically around the PPP, with some of the guidance being issued by the SBA to provide clarity. We know that has been somewhat of an evolving process, and so with that said, we know that there have been controls in place for any loan that you would have, but we know that there are some unique characteristics of PPP loans that may present some additional risks there. So I think the three areas of significant focus when we think about internal control over financial reporting are going to, let me see if I can get you to click to the next slide. I'm having a little bit of difficulty on my end, Josh. There we go. The three areas of focus are likely going to be in the initial establishment, the approval process, and the onboarding of loans. And then, the fee income is, obviously an area of incentive for many of the lenders to make sure that they're able to do this in an economic fashion, and support their borrowers. That is an area of increased focus, given that the fee amounts are going to be fairly considerable, depending on the volume of loans that were originated during this period. And then the back end phase of the end-to-end process of the loan is going to be this forgiveness processing. We also believe that this is going to be an area of increased focus as it relates to controls. So why don't we move on to the next slide, Josh, if you don't mind. So as it relates to the control considerations for the front end, as I mentioned earlier, many of the controls that you would have established for other loans, you would have had, your delegation of authority in originating the loan, segregation of duties, established lending limits in compliance with company policies, and then also making sure that the information that you're obtaining from the borrowers as part of that decision-making process meets your documentation requirements and reflects the risk to that borrower. Now, as it relates to the PPP, we know that there are certain amounts of information that were required to be received from the borrower. The use of funds was very specific as it related to supporting payroll costs, supporting certain overhead expenditures, and the like. And the determination or the percentage of the use of those funds was a critical component or element to the funding of these credits, as well as certain other factors, for instance, your BSA requirements and the like. So there are a lot of areas that I'm sure you guys have experienced as it related to the PPP process, where your typical underwriting onboarding stage may have been slightly altered, and as well as the very fluid timeline that I mentioned a little bit earlier created some additional risk there. So to the extent that certain procedures were not able to be established in a timely fashion, what I will say is that now is still a great opportunity to go back and revisit some of those loans that have been funded, to ensure that all of the support is on file, to make sure that the information that made its way into the system is accurate, and to make sure that you have all of your ducks in a row, so to speak, when the SBA does perform some of their review procedures over these credits. So let's go ahead and move on to the next slide, if you don't mind, Josh. And I'll try to request access again here. As I mentioned earlier, loan fee recognition is going to be an area of significant focus on the basis that, again, I think that the primary income generator here is going to relate to the fee income associated with these loans. As I mentioned, the fee amount is going to change. It's going to range from 5% all the way up to 1%, depending on the loan amount. And consistent with your onboarding procedures, you're going to want to make sure that you have requisite controls in place to make sure that that fee amount got recorded into your subledger or your system used to track these loan fees for accounting purposes. What I will say is that, from the discussions that we've had with our clients and customers, as well as our years of experience, we know that there's some diversity in the tracking and accounting for loan fees. Some institutions have a fully automated process where once they've input the information into the system really processes and accounts for that fee in accordance with GAAP or FAS 91. And we also know that there's some institutions who account for those fees on a more manual process, where they track these fees on an Excel spreadsheet to the extent that they don't have significant volume or the fee amounts are not significant to their operations. So it really is going to be on a case-by-case basis. I will say, to the extent that you have a more manual process, and that you had a significant volume of transactions that will have a material impact on your financial statements, I think this is going to be an ideal time, if you haven't already done so, to make sure that your controls are adequately designed to capture the onboarding of that information and the subsequent day two accounting for those fee amounts. Again, as a reminder, the accounting standard requires that fee amounts are capitalized day one and subsequently amortized or recognized, accreted into income over the life of that loan on an interest method. And so there's going to be some nuances there when you think through borrower ineligibility, where the SBA may come back on a loan that has been approved and funded and may require a subsequent reversal of certain fee amounts that have been recognized. Or you may be in a position where you've subsequently sold those loans, decided to sell a certain percentage of your PPP portfolio, And so there are accounting implications there as well in terms of whether or not you can go ahead and recognize that fee at that point of sale. And then again, thinking through loan payoff, ultimate collectability if it comes through forgiveness or if it comes through a subsequent payoff by the borrower themselves. So I would say, regardless if you're on an automated or a manual process, there are things that need to be considered that you may not have taken into consideration on a normal amortizing loan or on a typical credit facility. Let's jump on over to the next slide. So this next item here is just a polling question to really capture what I described there in the previous slide. We know that we've had conversations about what kind of process you use for tracking your fees. Curious to get a sense or gauge from this audience in terms of what you've been using to account for these fees. So the first one is manual process. Second one is using a core system to some degree, but not fully utilizing all of its capabilities. And then the last item would be fully utilizing core system. And we'll wait for a moment for responses. And while we're waiting on a response there, we did have a polling question that came in. I'll attempt to answer it, and I'll let Marshall jump in if he has a different perspective. The question is, I have heard to focus on those loans greater than $1 million. What are your thoughts? I think from a risk management standpoint, there will be greater emphasis on loans of a higher dollar threshold. But I also believe that there is also an important emphasis on any loan that you process. So I think that you need to make sure that you have controls in place, but most certainly if you feel as though there's some benefit to weighing your risks and rewards there, I would say that higher dollar amounts would likely be an area of focus as well from my perspective. So polling results, I think, are consistent with what we had expected, what I described a little bit earlier. We pretty much have a mixed bag. There are some folks who are tracking this manually. There are some folks that are utilizing the core system. Again, there is most certainly greater risk on a manual process. That's not to say that those risks cannot be addressed through designing adequate control procedures, but I would just continue to reemphasize that regardless if you're using a fully automated system or a manual system, you need to take into account some of those risks that I previously mentioned. All right, let's see if we can go to the next slide. And this is this last slide really covers that tail end of the end-to-end process that I was describing a little bit earlier, and that is the forgiveness of these loans. Now, ideally, the information that was provided by the borrower at loan origination is for the uses as prescribed by the SBA, and hopefully those funds were used in accordance with that initial expectation, and then on the back end, that information that's being provided is accurate from the borrower. We know that the forgiveness rules or communication has been an evolving process. We know that there's some information that's continuing to be finalized, but what we do know is that the borrower has an opportunity to have their loan forgiven. They are required to provide an application for forgiveness. And we know that the lending institution is required to process that information on a timely manner. And I believe the timeline is within 60 days to submit that information to the SBA. And then the SBA obviously has, I believe, a 90-day turnaround to make their decision. I think that the challenge that most institutions have expressed is their expectation, or their expectation of the SBA's expectation as to what their level of review should look like. So when the borrower provides the information to the lender, at what level do they need to dive into that information? Are they required to go in and perform detailed recalculations of the information provided? We'll discuss some of that in a greater detail a little bit later on. But needless to say, with the information that we do have present, we know that there will need to be controls designed and operating effectively to ensure that the information that's being provided from the borrower is timely reviewed, that it is reviewed in enough detail to support the SBA's rules, and that adequate procedures are in place internally to make sure that perhaps the individual that is preparing that documentation at the lending institution has someone coming behind them to verify the accuracy of the information. All of these controls are really designed to limit the risk and exposure to the bank. We know that there are certain clawback provisions within the rules, interpretations whereby which, if certain procedures are not performed or certain negligence is done on behalf of the institution, there may be some exposure there requiring a submission of P&I and or the fee amounts that have been previously forgiven or provided. And then as well, there's going to need to be controls designed to remove the PPP from the loan records once the loan is determined to be forgiven, and to record the SBA receivable, and likewise to continue to monitor those credits that are not forgiven and that are held by the lending institution. I think that's really, what we wanted to capture. We know that there are undoubtedly other areas that are going to be affected in the lending institution's control environment. We didn't talk about the servicing of these credits, the ongoing reporting of the 1502 forms to the SBA, et cetera. We know that there are additional controls that need to be designed to address these, but we believe that these are probably going to be the areas that deserve a considerable amount of attention on your part. So with that said, Josh, can we go on over to the next slide? And then this will be our final polling question for this section of the presentation. The question is, are you utilizing a third party to assist with the forgiveness process? And the answers, opportunities are yes, no, and unsure. We'll give you just another second here to answer that question. All right. So let's see if we can get the results up. This is actually interesting because I know that we've had conversations with many institutions, and we know that some institutions have elected to use third parties to assist them in this process based on the volume of transactions or loans that they've initiated. But we also know that some have decided to keep it in-house if they had a limited amount of activity and the manpower. I will say again, this is, as you know, and are aware of, this is going to be an area where you're going to want to make sure you have the right controls designed to address the risk, because the last thing that you want is the SBA coming back some time down the road in communicating that certain, procedures or certain documents that were provided or information that was decided upon may not meet their standards, and thus presenting additional risk and clawback provisions to the lending institution. So I'll go ahead and pass the next slides over to Marshall. So Marshall, if you want to take control.
Okay, thanks, Matthew. So I'm going to spend several minutes discussing some compliance considerations related to the Paycheck Protection Program, and then I'll also briefly discuss some just overall risk management implications related to the program. So just starting with compliance, I'll start with Regulation O. So this is specifically addressed by the Federal Reserve and the SBA. I'm not going to go into the full specifics of Regulation O, but really just a reminder that Reg O governs any extension of credit made by a bank to an executive officer, director, or principal shareholder of the bank, or any company of which the member bank is a subsidiary, or any other subsidiary of that company. And all of those individuals would be defined as insiders. It also applies to extensions of credit to a company that's owned by any of those insiders. So just from a timing perspective, this was one of those areas where, given the rush to implement the PPP, there was not a lot of guidance in the beginning. The program went live to accept applications on April 3rd. And notice the dates on both of these rules are after the first round of PPP was already exhausted. So during that initial phase of PPP, there were a lot of unknowns considering PPP loans that were issued to insiders. On April 17th, the Federal Reserve had issued an interim final rule titled Loans to Executive Officers, Directors, and Principal Shareholders of Member Banks. And so just stepping back a little bit from that, the Federal Reserve was allowed by regulation to exclude certain types of loans from the definition of extensions of credit if they determined they posed minimal risk. So the Fed's thought process was, since the PPP loans are 100% guaranteed by the SBA, they contain standard loan terms, they cannot be modified, and they're only available for a limited period. The Fed determined that, per the interim final rule, that the PPP loans pose minimal risk. So therefore, for the duration of the PPP, these loans are expressly exempted from the definition of an extension of credit and the corresponding provisions of Regulation O, and therefore they are generally not subject to insider lending requirements. So then on April 20th, the SBA provided some further clarification that PPP loans are not subject to Regulation O if that loan is made to a PPP lender's director and that person holds less than 30% of the outstanding stock or debt instruments of the lender, or the business is owned by insiders of a PPP lender's affiliate. So also in Reg O, it's just important to note that under both of these rules, that exception does not apply to a director or owner who's also an officer or key employee of the bank. So these employees would have had to obtain a PPP loan from a different lender they are not associated with. I'll get to some fair lending considerations later, but just a general reminder that the regulation did prohibit any favoritism in processing time or prioritization of an insider's PPP application in the loan process. So next compliance topic I'll just walk through is the Community Reinvestment Act. And there is some good news related to CRA in regards to the past 3 months of PPP lending. In general, most PPP loans will receive some form of CRA credit. Austin covered CRA modernization earlier today, but just a reminder that these guidelines I'll discuss are relevant to current rules of CRA and don't include any of the modernization. So within the FDIC's frequently asked questions regarding the Paycheck Protection Program, they stated that when consistent with safe and sound banking practices and applicable law, loans that benefit small businesses and small farms impacted by COVID-19 serve the long-term interests of those communities in the financial system. Generally, loans to for-profit businesses in amounts of $1 million or less are considered small business loans in CRA evaluations, and therefore they receive credit in consideration under the lending test. Additionally, PPP loans to small businesses could receive consideration as innovative or flexible lending practices. If you have a loan greater than $1 million to a small business that creates or retains jobs, that would qualify as community development loans under economic development. If the loan creates or retains jobs, or under revitalization, stabilization, if it benefits primarily low and moderate income areas or distressed middle income areas. So some other guidance that has been released related to CRA and PPP is the March 19th joint statement. So this joint statement provided some examples of other activities that have the potential to qualify for CRA consideration. I've listed several examples of those activities on this slide, but in general, banking services and retail lending activities in your assessment areas that are responsive to the needs of low and moderate income individuals, small businesses, and small farms affected by COVID-19 are going to be favorably considered. If you've done any of these activities that are listed, such as waiving overdraft fees, waiving late fees, had and implemented a payment deferral program, implemented a new short-term loan product, all of those types of activities could receive CRA consideration in your next exam. Also, just a reminder that favorable consideration will be given to community development activities located in a broader statewide or regional area that includes your CRA assessment area. That's provided that you are also responsive to the community development needs that exist in your own assessment area. So don't just think about just your own assessment area. Think about everything from a larger regional area. So really overall from CRA's perspective, those that participated in the Paycheck Protection Program should have it a little easier in their upcoming CRA examinations. Okay, so now on to the Bank Secrecy Act, and here I'm going to focus on the beneficial ownership requirement. And just a little background reminder from a couple years ago that a bank must establish and maintain written procedures detailing identifying information that must be obtained for each beneficial owner of a legal entity customer that opened a new account, and this was effective May 11th, 2018. So this is the fifth pillar of BSA, if you've heard it referred to as that. So the main question here, which was addressed by the Treasury's frequently asked questions, is if you originated a PPP loan to an existing customer, would that be considered a new account for customer due diligence purposes and then require collection and verification of beneficial ownership information? So the Treasury's answer to this was that if it's an existing customer where you had previously already obtained beneficial ownership information, then you're not going to be required to re-verify that information. However, if you have not yet collected beneficial ownership information on that customer, for instance, maybe they haven't opened a new account since 2015, then you do not need to collect and verify beneficial ownership information for that customer, with the caveat that unless your risk-based BSA compliance approach indicates that you should have collected and verified that information. I think based on most BSA programs that I'm familiar with, I think a majority here will have required the collection and verification of the beneficial ownership information. So I think in most cases that was occurring, but that's the Treasury's stance on that. So if you're not going to require additional beneficial ownership information in these circumstances, then I would recommend ensuring your BSA program is consistent with that decision. And then even if it's after the fact, adding a brief addendum to the program if it's not already there. Finally, just a reminder for BSA that if you required a new or an existing customer to open a deposit account in relation to obtaining and applying for their PPP loan, the collection and verification of beneficial ownership information would have been required in that scenario. So now for fair lending. So I think this is probably the biggest kind of risk area from a compliance standpoint in regards to the Paycheck Protection Program. So I'm going to start off the fair lending discussion with just a quick review of Regulation B, which is Equal Credit Opportunity Act, or ECOA. So ECOA prohibits discrimination against any business or consumer credit on a prohibited basis regarding any aspect of that credit transaction, including the application process. So just a reminder of what the prohibited bases are. That's race, color, religion, national origin, sex, marital status, age, receipt of public assistance income, or if you happen to have someone that has exercised a right under the Consumer Credit Protection Act. So now that we have that kind of just overall refresher out of the way, I want to spend a minute talking about the concept of gating requirements that were implemented by many lenders. The majority of banks I've spoken with, we've had the opportunity to take a look at, have employed this concept in some form or fashion. Typically, this consisted of prioritizing existing bank customers or customers without other lending relationships, and in many cases, completely refusing to accept applications from new customers. These actions were not expressly prohibited by any of the guidance or regulation, but they do increase risk that similarly situated businesses were not treated the same, which could turn into a fair lending issue. And I foresee this being the greatest area of compliance risk in the coming months and years. You're already seeing out there in the marketplace class action lawsuits being filed because of these gating requirements that existed. All that being said, I don't think any of these gating requirements were implemented with an ill-willed intention. Just given the breakneck pace of getting ready to accept PPP applications, there were understandable limitations for everybody that was involved. There were only so many people around to process applications. The guidance was and still is ever-changing, and there was a limited availability of funds that went very quickly, especially in the first round. This led to many only having the resources to focus on their existing clients, and I'm certainly not saying that was an incorrect decision at the time. I do think, however, that even if you have to go back now after the fact, that you should document this business justification and thought process just to avoid any hiccups down the road. Kind of after you get through that initial documentation standpoint, another good place to start would be an analysis of your PPP approvals and denials, and thoroughly investigating any complaints you might have received during the existence of the program. So I'll end the compliance kind of piece of the discussion before I move on to some risk management considerations, just with some guidance related to adverse action. So again, Regulation B. So ECOA requires you to provide an adverse action notice within 30 days for a business that grows less than $1 million, and then within what it calls a reasonable period of time for larger businesses. Definition of a completed application under ECOA includes any approvals by a governmental agency necessary to guarantee the credit. So you can imagine SBA PPP would be applicable there. So under that definition, if you have not received a loan number from the SBA or response about the availability of funds from the SBA, then you don't have what is considered a completed application. On the other hand, if you decided not to submit the application to SBA, made a credit decision without submitting the package to the SBA, then you've made a decision not to grant credit on an incomplete application. And that does require an adverse action notice within 30 days or a reasonable period as applicable based on the business size of $1 million or less in gross income. So finally, just if you didn't receive a response from the SBA, then you're kind of stuck in the middle here. So as the application cannot be denied as it's incomplete, or it cannot be denied as incomplete because the applicant didn't fail to provide any required information. They provided everything they were required to. So in this case, you kind of just have to wait for a response from the SBA before proceeding with any adverse action requirements there. So I'll move on to a polling question here. Just in general, I know I focused on a lot of compliance concepts there, but have you updated your 2020 internal audit plan to consider SBA PPP loans? Options are yes, no, and unsure. So I'll just give just a couple minutes to go through that question. Okay, so responses there. So 47% yes, and then the remainder no or unsure. I would say if you have not gotten around to updating your 2020 internal audit plan to consider some SBA PPP in some form or fashion, definitely do so. This is so much has changed in the last 3 months, from processes and procedures, from Matthew talking about internal control implications to compliance risk, to basically a completely new loan product that greatly increased balance sheet. So definitely recommend considering that in some form or fashion with your internal audit plan for the coming year.
Hey, Marshall, I would just say, to add on to that, that was actually a reference I was reading, and if anybody needs a copy of this, I can send it out, but it was last week. There's state and federal guidance came out via interagency guidance on examination, key examination issues from really all regulators. And one of those issues is, how are you taking into account COVID, PPP, and the related items within your risk management platform as well as internal audit. So I think it's fair to say not only those that have Sarbanes-Oxley or Fiducia will need to consider those, but I think there's going to be an expectation of consideration within the internal audit plans.
Yeah, certainly agree. So I'll move on to, I'll move on to risk management from the client standpoint. So really earlier from a risk management standpoint, earlier Matthew discussed forgiveness from an internal controls perspective. And kind of while forgiveness is certainly an important consideration from a risk management perspective, but since we've already spent a little bit of time on that aspect, I'm going to spend my time talking about another risk, which is denial of the SBA guarantee. So I think this is something that people might not think about quite as much as the forgiveness aspect. So the risk related to denial of the SBA guarantee really began back at the origination of the loan. So the lender requirements for underwriting are included in the SBA interim final rule, and I've listed them here. So at first look, they seem fairly self-explanatory, rely heavily on borrower certification, until you get down to the third bullet point, where the lender is required to confirm the payroll costs by reviewing the payroll documentation submitted with the borrower's application. So really here, the main question is, to what extent were you required to review that payroll documentation? So thankfully, the Treasury and the SBA put out some frequently asked question document that stated that the lender is not required to replicate every borrower's calculation. However, they are expected to perform a good faith review that's in a reasonable time of the borrower's calculations and their supporting documents concerning their average monthly payroll cost. If, as part of that good faith review, you find an error in the calculation, or there's a material lack of documentation provided by the borrower that supports that calculation, you're supposed to work with the borrower to remedy any of the issues that might exist there. So this brings me to kind of the SBA's statement that they will review all loans in excess of $2 million in addition to other loans as appropriate. So the outcome of this review is not going to affect the guarantee, with the important caveat that the lender complied with those lender obligations that I just discussed. So we'll kind of just have to wait and see the extent and depth of the review by the SBA for loans over $2 million, and how, if at all, they select loans less than $2 million. But I think there's just a lot of gray area with respect to that good faith review requirement. And the SBA might, at the end of the day, be looking for any reason to just deny their guarantee. I'm not saying that'll happen, but it's definitely out there. So kind of the last piece I'll mention here from a risk management standpoint is the borrower requirement at the initial application phase to certify the necessity of their loan request. So this is what you saw in headlines with Shake Shack, Ruth Chris, among others, just appearing in the media. So if, as part of the SBA's review, they conclude the borrower did not have adequate necessity for the loan, The SBA will seek repayment of the loan balance and then inform the lender the loan is not eligible for forgiveness. So important aspect here is this conclusion does not affect the guarantee, but it could just cause some additional headaches in the forgiveness process if you would have any borrowers where SBA concludes the loan was not necessary. One final note, just on a kind of recent guidance that's been published out there, I'll make is the OCC recently published yesterday, in fact, their semi-annual risk perspective. There's a section included that specifically relates to government relief programs. So I'd encourage everybody to read through that if they have not already. But really the root of the section just discusses the vast modifications to all the operational processes and controls that have occurred in the past 3 months, by way of the CARES Act, Paycheck Protection Program, remote working, ever-changing regulatory guidance, and just how much of a great effect that is having on the risk profile of institutions. So definitely recommend taking a look at that if you have not had a chance to read it. So that's all I have here. So I will check and see if we have any questions submitted, but I don't know that we have anything else. So with that, I will turn it back to Josh.